Hi everyone and welcome to the Black Barristers Network event, A Barrister's Guide to Finance. My name is Natasha Shotunde. I'm a barrister at Garden Court Chambers and I'm also the co-founder and chair of the Black Barristers Network. For those of you who do not know about BBN, we were set up in 2019 to promote the growth of Black barristers by providing support, visibility and community outreach. Further information about us can be found out on our website at www.blackbarristersnetwork.org.uk. And if you have any queries about what we do, if you have any ideas for future events, then please do email us at info@blackbarristersnetwork.org.uk. So tonight we have an expert panel who will be discussing all things finance, from pensions to investments, savings, mortgages, and tax. The panelists will each provide a short presentation followed by a Q&A, and I'm going to introduce each panelist as I go along. So if you have any questions for the speakers, please use the Q&A function and add the question in there. You can post it anonymously if you would prefer. The chat function will be open tonight, but it will only be used for comment. So please do put your questions in the Q&A box rather than the chat function. Now, tonight's event is being recorded, but only the speakers will appear in the recording. And the recording will be uploaded onto the BBN website, where you can find recordings of all of our previous seminars. So first up tonight, we have the fabulous Fee, who is the co-founder and one half of the Coco Financial Duo. She's an ACA qualified chartered accountant and a serial entrepreneur with a keen interest in empowering historically underrepresented groups and equipping them with business and finance confidence. Now, unfortunately, Fee will not be able to stay for the Q&A. So if you have any questions for her, then please feel free to email her and she will put her email address in the chat function during the event. Right, over to Fee.
Hi, everyone. I'm just going to share my screen now, so give me one moment and we'll get started. Let me know if you can see that. Just if I could get an audible yes from someone, that would be helpful. Okay, cool, good to go. Right, so let me move this out the way. So yeah, we are doing the Money Moves Mind the Gap talk. And I just introduce myself and my business partner who's not here. So Shan, who is on the left in the image, she is co-founder of Coco Financial. She's an ACCA qualified accountant, currently working at a FTSE 100 company and a proud new mama. And that's why she's not here today. I guess clashes with bath time. I'm sure any parents can relate to that. I'm Fee, co-founder of Coco Financial, also founder of Lime Hut, which is a contemporary Caribbean street food brand, and I qualified at Deloitte. We run Coco Financial, which is essentially a business consultancy aimed at female startups. However, we identified a gap over the last year that not just when it comes to business finance and accounting, but just finance generally, there seems to be a real gap in either confidence or knowledge when it comes to women in particular. So we are aimed at women and there will be quite a female focus with my talk today. However, a lot of the takeaways here are very universal and I won't apologize for the female focus because I think it's incredibly important. But like I said, lots of universal takeaways for everyone. So for your reference, and as you're all barristers, I'm sure you'll appreciate this little legality here. The information presented in the seminar is for general information and use and is not intended to address your individual requirements. So I'm going to talk about the gender pay gap really quickly just to set the tone. The gender pay gap in the UK is currently 15.5% in 2020. This is down from 17.4% in 2019, which is an improvement, but still 15.5% of the way to go. The gender pay gap is caused by various factors, that being, fewer women in senior roles. This next fact just absolutely kills me. There are more CEOs named Peter in the FTSE 100 than there are female CEOs altogether, just to really make that, hammer that point home. There are more women working part-time, often to do with balancing childcare requirements. And so that's a motherhood gap that's exacerbated by this gender pay gap. The Global Gender Gap Report revealed that gender parity is unlikely to be obtained for basically 100 years, which is pretty stark. Now, I bring this up to now discuss the pension pay gap because UK women face retirement with 39% less in pension savings than men, which is close to triple the average gender pay gap discrepancy, and no one's talking about it. Plus, to make matters worse, women live longer than men on average, I believe 8 years on average, so you have even less money to live on for even longer. 3 in 5 people don't know how much is currently in their pension, and it's definitely one of these things that people bury their heads in the sand and don't like thinking about. We're going to change that today. So what even is a pension? In very simple terms, a pension scheme is a type of savings plan to help you save money for later in life when you hopefully stop working. The money is paid into the scheme, and that money is then invested by the pension provider. And the amount available to you at retirement depends on 2 things, and that is how much you've paid in over the period of time before you get to your pensionable age, and how well that investment has performed. There are very favorable tax treatments compared to other forms of saving. So if you are paying into an employer or sort of individual pension, the government tops it up by 25%, depending on your tax banding. Equally, if you have a limited company and you make employer contributions, then that is a completely 100% tax deductible expense. So you therefore save on corporation tax by increasing pension contributions. So it's a really favorable form of saving, and the government is basically throwing free money at it. So that speaks to how important the government think it is to save into a pension. And why are pensions important? So the state retirement age for men and women is now 66, but the average life expectancy outstrips this by quite some margin. So the average person is expected to live about 15 years after working. And so it's a sensible and safer way to invest in your future self if you don't want to work until your dying days. A little tip, and this, all investment strategies are completely individual and not everyone has to take them on board, but a general tip that has been sort of put out there if you want to enjoy the lifestyle that you currently have is to put in half of your age as a percentage. So I am 31, therefore I should be putting in between 15 to 16% of my monthly annual salary each year. Now that's quite punchy, it's quite a lot. Not everyone can afford that amount, but there's definitely easy ways that you can get to the amount. One of them being if your employer does matched contributions. A lot of people just go straight into the default fund and don't ever think about it again. And the default is that you pay 5% and your employer pays 3% if you're enrolled into auto-enrollment. But often many progressive employers will have some really awesome matching policies. So let's say you want to put in 6%, they'll put in 6%. If you want to put in 8%, they'll put in 8%. And quite quickly you can get to an amount that totals half your age as a percentage. And don't worry if you're not yet at that stage. It's just something to be mindful of rather than burying your head in the sand and not thinking about it at all. So my very unhelpful but honest view is start yesterday. Retirement feels like ages away, and people want to put this into their mind. They're like, I'll think about this when I'm 50, but inaction means you lose out on compounding. And this diagram here is a really simple chart that helps show the magic of compounding. So this shows the difference between somebody who started investing $100 per month at a 5%, this is a flat 5% annual compound interest rate at the age of 25, versus somebody who started at the age of 35. So what you can see, this curve here is the compounding effect happening, and this curve goes up so that when this person gets to retirement age, they've got 160K in their pension pot. Versus somebody who starts just 10 years later, we can still see a curve, so compounding's happening, but it's, I'm just looking, it looks about 80, 90K, basically half of what somebody would have had in their pot by starting 10 years earlier. So compounding really makes such a difference. So some general pension guidelines for you. Take risks in your 20s and possibly into your 30s. Start to go steady into your 40s, and then you definitely want to reduce the risk in your 50s. An example of some standard funds, I've just taken these from the Nest website. Nest is one of the largest and most popular funds used by many, many employers across the UK, but it's just one of many. They have the Nest retirement date funds, which moves in this sort of trajectory. So it's quite volatile, it's quite risky, invest in riskier funds in your 20s and 30s. It goes quite steady and very vanilla in your 40s and gets incredibly basic by the time you get to your 50s, because you don't really want volatility and sort of taking those risks the closer you get to retirement age. There's the higher risk fund. If you want to, if you've got a risk appetite that's a lot more than your average person, you may want to have a higher risk fund. You'll see much more volatility, more likely to have losses as well as wins along the way, but with little risk comes a reward. There's ethical funds if you care about not investing in big oil, Sharia fund if you are Muslim and follow Islamic law, lower growth funds for very risk averse people. That would be someone like my mum. She would rather know that if she put in £100 today, that in 2 years' time, it was still worth £100 rather than take the risk that it could be worth £80 or 200. So there's all types of funds, and I sort of nudge you to just have a look at what funds your pension is currently going into, because it's another thing that people bury their head in the sand and don't want to think about. So talking about the risk appetite gap, because this is something really big with women compared to men. Stats show that culturally women are way more risk averse than men. They tend to have safe cash savings instead of riskier investments. But with little risk, as I said earlier, comes very little reward. So let's break this down. I said honeys, but to all you lovely men as well. So let's talk about cash saving versus investing. So when we're talking about cash savings, you're holding cash in a bank account, the money is available to you in the short term, nice and easy. When you're investing, yes, there's more risk, but perhaps more reward. But because there comes risk, you want to think about this as a longer term strategy. You've all heard the phrase, cash is king, but is it really? So things to consider with cash is, you're setting money aside for a short term, low risk, low reward. I mean, interest rates are painfully low at 0.1%. There's even been talks in the past about negative interest rates, which would technically mean it would cost you to save. This is not as great as it sounds. So when you think about the time value of money, and what I mean by that is the cost of living going up, inflation, therefore meaning that your £100 today is not worth £100 in, say, 3-4 years' time. In real terms, cash is actually a loss. And it has been consistently for my entire adult life, perhaps even my entire human life. Whereas compared to investing, you want to think about this if you're planning ahead and won't need the funds in the short term. But the one thing to note is, generally speaking, when you look at this in the long term, investing tends to outperform inflation in a way that cash simply has been lacking. So what can you invest in? Everyone knows about stocks and shares. Then you've also got bonds, funds, government bonds. The property market is one of the largest things that people invest in. And you've also got ETFs, which stands for exchange traded funds. So it essentially tracks an index or a commodity like gold or silver, and it performs based on that. You've got more exotic investments, including farmland, vintage cars, wine, art, and even handbags. Here's looking at UMS, because that has outstripped and outperformed the FTSE market for the last 3 years in a row. So if anyone tells you a handbag isn't an investment, tell them they're wrong. And I'm going to tell a quick story about wine. I've got a friend who was gifted some port wine when he was born for his christening. He was gifted 780 bottles of port wine, which is a very old school Victorian christening present, apparently. But his godfather was onto something, because when he turned 21, he got every single bottle valued, and they were worth between £350 and £500 each. And basically overnight he had 350k, which is a pretty sweet investment. So there are things you could think about other than just stocks and shares. But before you start your investing journey, you have to sort your basics out first. So when it comes to debt, tackle expensive debt first. Not all debt is equal. So, you don't necessarily need to pay off your entire student loan. That's not attracting high annual percentage rates like credit cards. So you do want to tackle those more pricey debts first. You want to build a rainy day fund, also known as the FOF fund, just so you've got 3 months worth of living expenses. And once you've got to that point, it's time to start investing. But remember to hold out long term, because the market will fluctuate, but you only win or lose when you cash out. And here's an example. I mean, this is just the world indexes here. But what you're seeing here is up and downward movement. Hopefully you can see my cursor. There's up and down movement constantly, but in pretty much, for the most part, an upwards direction. So if you were just looking at this 1 year here, I mean, looking at the end of 2018, this purple fund here, which is the NASDAQ, that dropped so sharply that anyone looking at that in a 3-month period who had maybe just started investing at that point. If their funds had moved in line with this particular fund, they would have seen a really dramatic drop, which seems really horrendous. But if you're holding out in the long term, which is the entire point of investing, at least if you're investing for a longer term strategy, you can just shrug your shoulders when you're seeing these high wins and these high losses, because you know that overall you've got a longer term strategy, and it's about having that confidence to hold out. Because if you do take your money out in these lows, then you have lost. So what's holding you back if you haven't started your investing journey yet? Something we often hear is, I'll start when I'm older, when I'm richer. But as we've discussed, the effects of compounding are magic. So start today, even if you start small. And I'm sure someone else will cover this later on in the panel, but there are robo-advisors, and you can start from as little as £1. So there really is no excuse if you think you're not old enough or rich enough just yet. And I'll just finish on this last point here. This tweet went viral, and it went viral for a good reason. If you invest 10K a year at 7%, it takes you about 8 years to hit the first 100K. But it only takes 2.5 years to go from your 400K to 500K. So essentially, you do the heavy lifting at the start and your money will do the rest later. That's all from me. If you guys do have any questions, please do drop them in the Q&A box. I do have to dash, unfortunately, but I will drop in my email, my contact, so you can get in touch if you have any questions. But I'm confident that you've got such an awesome panel for the rest of the evening that they'll be able to answer many of your questions. So thank you very much for having me.
Fee, thank you so much. I don't think you understand how helpful that was. Like Mavis, who is another co-founder, she's the vice chair of the Black Barristers Network, and we've just been like frantically WhatsApping each other, just going, oh my God, all of these figures. So thank you so much. And as Fee said, if you had any questions for her, she'll probably put her email address into the chat now before she do that. You can ask her some questions. Thank you so much for that. That was super helpful.
No, not to worry.
I mean, the 10 to 15, was it 15 to 16% for the pension?
I mean, that was because I'm 31. So it's whatever your
age
is.
So that makes
then you're the same. Yeah, so it's half your age. So, if you're 20, 10. If you're 40, 20. But, these things are difficult, and I'd say use that as an aim, and it's not a hard and fast rule. There are that, and that's also predicated on the fact that if you're only using a pension to fund your end of years. If you've got other investments, property, there are other ways that you can get there, but it's a nice marker to have.
That was really helpful. Thank you so much.
That's all right. Take care, everyone. Bye.
So when I saw our next speaker's bio, I thought to myself, what have I done with my life? Once I read it out, I'm sure you guys will be impressed too. Carl Hazley from Finimize is responsible for content across all channels and market analysis for external publication at Finimize. He spent over 6 years at Goldman Sachs as an equity research analyst, leading the European Internet research team. During his tenure, he led an IPO of Just Eat, among others, and covered stocks like Zalando, Rocket Internet, and ASOS. Carl's expertise covers a range of topics regarding markets from macro to sector and company analysis. He's particularly versed in discussing internet and consumer-facing business models, startups, including fintech, and developed market economies. And he has kindly provided you attendees with a 34% discount off of the Finimize app. You should have received the link to that in the email that was sent today with joining details, but I'll also include that in the chat while he's talking. So everybody, here is Carl.
Hello, everyone. Good evening. Thanks very much for having me here. Maybe if I share my screen, I've got a few slides to help guide the discussion. I think Fee's already done a lot of the heavy lifting for me. I don't need to necessarily sell you on investing or planning for the future. But what I do have for you is 4 slides to guide the conversation and to help answer the question that we try to answer for our members every single day, which is, why should I care? We answer questions like, why should I care if interest rates are going up or down? Why should I care about Bitcoin's price? But today I'll answer the question for you, why should you care about Finimize? And maybe more importantly, what can Finimize do for you? I'll keep it quick so that we have lots of time for questions at the end. So that chap on the left is our founder, Max. And why we started Finimize and how he came up with it is trying to solve this problem, right? He did what he was told, he studied hard, got a good job, and made a dent in his student debts, and even started to build up some savings. That's great, but what next? And that might be the kind of thing that you guys as barristers are facing and thinking about. And you're not alone. 86% of millennials save every month, but they keep most of their cash, most of their assets in cash, most of their savings in cash. Why? We believe it's because there isn't really a suitable way to get financial advice on your own. So digging into that, if you look at this chart, you can see that since 2001, with the exception of a couple of years, the proportion of people under 35 investing in stocks has been falling. That's despite the surge in wealth tech, robo-advisors, and other ways to make investing easier. And yes, if you extended this chart out 3 more years, you might see a bit of a bump in 2020, given the hype in the US around Robinhood and also globally around cryptocurrencies, but overwhelmingly over the last 2 decades, the trend is negative. And if you dig into why, there are a couple of clear reasons. Most people want direct control over their wealth, but they don't know how to take that control. And so that stops them dead in their tracks. And then if you look at the 90% of people, if you look at the remaining people who do take action, 90% of them look at their peers, they ask their friends and family what to do, and they look at the media. And I'll come on to how we've built Finimize on those 2 pillars. But what I wanted to make clear up front is, I think, this problem, which is fewer people investing for the long term, is doubly true for minorities, and I'd say even triply true for Black people, because at least in this country, and this is true in most Western countries, Black people have less access to capital for reasons we all know, less capital full stop, are more risk averse, are less engaged in these sorts of conversations, partly for that reason. And as Fee said, look, maybe in your 20s, you don't need to think about investing or your pension or the long term quite as much. But when it comes to retirement, the simple fact is, if you leave your money investing, between 5 and 7% by default in a basic fund that's not doing anything for you, you're probably going to live longer than your money when you do retire. And that's a terrifying position to be in. So how do we solve this problem for you? We have 4 pillars at Finimize. The first is the daily brief, and that aims to drive awareness. In our app, you can listen to it. And let's say in this example, Michelle here, who's our example, let's say she hears news about BlackRock investing $1 trillion into ESG-friendly, green, environmental, socially aware investments over the next few years. That drives your awareness. You understand what BlackRock's doing and why it matters, and we'll explain all that to you. And let's say that piques your interest. You want to dive deeper on this topic of on this topic of investing sustainably. In our app, you'll find packs and insights in text and audio. And in between 7 and 15 minutes, you can listen to the pack here on socially responsible investing, learn about the ins and outs of socially responsible investing, or you can hear an Analyst Insights by one of the team at Finimize, either someone like myself, or we have analysts, other people, ex-Goldman, places like Fidelity, Bloomberg, diving into the analysis around, maybe I'll tell you something that's coming later this week, is a deep dive on how Joe Biden's stimulus plan will benefit certain energy companies or alternative energy companies. And from there, you can join our premium groups, where you can speak to other Finimizers in group chats, and you might be like, hey, I'm trying to learn more about this. How have you gone about making your sustainably focused investments? And someone might say to you, actually, there's a meetup on this topic. And actually, the picture here is a real example where we had the head of sustainability from JP Morgan Asset Management. She came and spoke. She was an expert, obviously. She came and spoke to our audience about how JP Morgan approaches the challenge of sustainable investing. And in that way, you can learn from an expert, but also from your peers. And what that does is take a really, theoretically at least, a very tough mental challenge, which is getting your head around something like sustainable investing, and condense that into a few weeks with guides, with the content, with the community, in a way that, in the course of a few days, puts you in a position to make a better and a more informed financial decision. And what we do when we're doing that is, and this is a slide I took from somewhere else about why people use us. These are the promises that we make to you. We promise expert analysis in your pocket. That's from, like I said, the team, ex-Goldman, Fidelity, and so on. We keep everything bite-sized and jargon-free. So you can read something in between 3 and 5 minutes. You can listen to it in between 6 and 15 minutes. We're apolitical, we're unbiased, and we're global. Because we don't have a broker attached, we don't make money from you trading or buying or selling, anything like that. We don't care if you take action. We're not pushing you to go and trade something or to go and invest in something. We're giving you the information to make an informed decision. We make our money from the subscription rather than from you taking any action. And we teach you along the way. So as an analyst, I have a framework for almost everything that I do. I'll explain my framework for assessing whether it's Microsoft or a cryptocurrency. I'll explain how I think about that. We also expand your horizons because our analysts are looking for ideas that might be off the beaten track. We're curated and straight to the point, and we have that community that I think is really, really important. And like I said, we don't encourage trading. Similar to what Fee was suggesting, most people should probably just invest in low-cost options that will compound over time. And that's all well and good. How we make our money is charging a subscription for full access to the app. There's a discount code that Natasha mentioned that you'll have seen. So I'll let the app speak for itself in that regard. But the last thing I wanted to wrap up on is, rather than dive into what's going on in markets and how certain investments might be attractive here and there, I want to give you a flavor of some of the things in the app, just to show you how we approach those discussions rather than having those discussions unless they come up in the questions. So these are 3 examples of daily briefs. On the left, you can see here, we're talking about Coinbase last week. Coinbase is the second biggest cryptocurrency exchange, and cryptocurrency has been very much in the news for good and for bad over the last few weeks, months, years. And not only did we talk about the Coinbase, the fact that investors can now buy into Coinbase's shares, we've dived into the relationship between Coinbase and Bitcoin, which is something that a lot of people have been asking us about and is worth understanding. That's one sort of thing that we do. We'd also, in the middle, look at Microsoft. So Microsoft just announced an acquisition in an interesting high growth sector. Now, you might not care about Microsoft and you might not care about what it's doing, but the fact of the matter is, if you are an investor of any sort, and if you've got a pension, by definition you are, Microsoft, well, let's start big picture, the US stock market is half of the global stock market. And within the US stock market, Microsoft is about 3%. So if you have an investment portfolio for your pension, which you most likely do, that includes global stocks, you do have an interest in Microsoft. And so whether you're an active trader or an active investor, or just somebody going about their business not looking at this stuff, it's important to know what Microsoft is doing because it does have an impact on your investments and on your pension. And then we also take a step back, and you can see on the right here, we have a daily brief focused on China. And yes, its economic growth in the first quarter of the year was good, but we explain why that is good news for the world stock markets, including in the UK. Another couple of examples. So these are our Analyst Insights. This is where an analyst goes off and does some primary research and shares their ideas. On the right, working backwards, here is, we're coming into earnings season, which is where companies periodically tell us how they've been performing in terms of how much money they've made. And there's a one-of-a-kind opportunity that I've never seen before, and it's worth paying attention to. Even if you're not going to invest in it or trade or anything like that, it's worth being aware of. We also had one of our analysts dive into the proposed global tax hikes coming out of the US and a few other countries. What does that mean for your portfolio? What does it mean, and how can you mitigate against it? And then we also look at things that might be off the beaten track. So lab-grown meat, Bill Gates-backed company. We've analyzed it. We've looked at the pros and cons and given you the tools to decide whether it's something you want to take the risk on or not. And then very last, we have what I call packs, which are extended sort of longer form content. If you do, we'll go down the investing and trading route. We have packs that touch on valuation, how to actually figure out what an asset's worth, how to hopefully separate your biases from the markets through understanding behavioral investing. Along from the left, you can see more topical packs. So we've talked about crypto being something that a lot of people are talking about. We have deep dive content on those topics, both created by our analyst team, but also from our events. We have investing masterclasses looking at some of the best, most famous investors in the world and what we can learn from their methods and apply to our everyday lives. And we also, I just thought it'd be cool to show off, we've interviewed C-suite execs, so people like Sir Martin Sorrell, and understand how he thinks about the media industry and how it's going to evolve. So even a step back from just investing and saving, thinking about the long term, just kind of interest around world of business. So that's it from me. Look forward to your questions later on.
Hi, so sorry for the delay. I just had someone buzz because of a delivery for something that I've never ordered. Anyway, thank you so much for that, Carl. That was super, super useful and very interesting. And as you all know, you've got the link in the chat. Please feel free to purchase the app and get going. Right, so our next speaker is from Henry Donnell, and her name is Courtney Flockhart. Henry Donnell provide bespoke mortgage brokering services for private clients, and they are the mortgage brokers of many, many barristers. And today we have Courtney, who's going to be presenting for us. She's an incredibly driven and enthusiastic power planner who's already got a wealth of experience dealing with clients and their complex requirements. She prepares and administers client applications with minimal fuss and the high level of service that her client expects. And she's going to be talking to us about all things mortgage. Courtney, take it away.
Hi everyone. So yeah, we at Henry Donnell, we really do specialise in barrister mortgages. My boss, Kem, he's been in this industry over 17 years and he's built up a very strong profile of barrister clients. So that's kind of our main focus in the legal profession, really. So we have an extensive experience across that. And because we have so many clients in that area, we've really gained a strong knowledge on each different component of your guys' income and how that can be different, and how unfortunately if you go directly into a bank that can be quite difficult for them to understand. You get a very computer says yes and computer says no approach, which we don't really like, and we like to try and resolve that, because I think a lot of barristers that we deal with and a lot of clients that have gone directly to a bank and then come to us after the fact are a bit disheartened because they think maybe that they can't get that house or they can't get their first flat. They've got to wait a few years to be able to do that, when in fact that's really not something that they have to wait for, because we can help you get to that level now based on our understanding of your guys' income. So one thing that we mainly experience is people on pupillage. Usually if you go to a bank with that, they're not going to understand that income. They're not going to have a good understanding of how that works in your first six, second six, potentially third and fourth. So we use our knowledge on that to be able to explain to them your projection of income. We contact your clerks to get that information and say, yes, they're going to be on this for the first six and this for the second, but in their third, fourth, fifth, sixth year, this is where you guys are going. So we use all of that information to kind of really present a case to a bank, whether that be you being on pupillage or potentially only having 1 year of accounts, because I think that your guys' income can basically skyrocket, really, going from a smaller amount on pupillage, and then your first year can just really go straight like that. So we use all of the information we have on all of that to really push towards moving forward with getting you what you need, whether that be you need a 5 times income multiple or you need to go a lot higher than that. We kind of make it work as much as we can for you to get you to that higher level. Another thing we really specialize in is when you take silk, when you get a judge appointment, when you get your recorder appointments, we get all of that information and we really present the case to the lender, whether that be, oh, we need to use a little bit of it, or we need to use all of that income to get you where you want to be, because banks currently, because of COVID, are being really restrictive on the type of income they will and won't accept. So, for example, income multiples used to be 5.5% at 5.5 times, but right now they're dropping those for certain clients because they're worried about your guys' income moving forward. But with barristers, we have a really strong relationship with underwriters to be able to present all of that income and all of those details to kind of really present you guys as this is a client you really want to lend to and a client you really want to have in your books. So that's basically what we do, is we hold your hand through the entire process, from inquiry to you guys coming to us saying, we found this flat, we really want it, we found this house, we really want it, but can I get there? And the idea is we get you there, we all the way through the process from when you come to us with that and we submit the application for you, go all the way through to the end until hopefully you've got the keys in your hand and are looking to proceed from there, really. That's pretty much a summary of what I had to say on it, really, because that's how we add value. Whether you go to the bank directly, you're not going to get the service that we're going to give you, because we're going to be able to look after you throughout the entire process, really. So yeah, that's what I have to say. And if you guys have any questions, please feel free to put them in the question section, and I'm happy to answer them. And we'll put our contact details there if you want to get in touch about your mortgage, because we deal with remortgages, purchases, any type of mortgage transaction we can help you with.
Thank you so much for that, Courtney. That was super helpful. I know from personal experience that there is no way on God's green earth I would have been able to get a mortgage without a broker. So I would thoroughly recommend to everybody who's intending to get one. They're super helpful. Our fourth speaker is Louise Crush from Westgate Wealth Management. Westgate Wealth Management provide comprehensive financial planning and wealth management services, helping individuals, trustees, and businesses to achieve their financial goals, irrespective of their resources or life stage. They are a partner practice of St James's Place Wealth Management, and they provide specialist advice to the legal profession, including the bar, and are a service partner of the Bar Council. Over to you, Louise.
Thanks, Natasha. So I'm just going to get presentation up and running. Okay, so as Natasha said, I'm part of Westgate Wealth Management, and we're a partner practice of St James's Place. So just a little bit of background. As a partner practice, we're under their umbrella company, so everything that we do for our clients goes through St James's Place Wealth Management, and our clients are clients of St James's Place. We've been a service partner of the Bar Council now for about 3 years. As you can see, my background initially was in fact in the legal sector, but I'm now a qualified financial advisor, regulated, and my role at Westgate is to assist people throughout their financial journeys to achieve their financial goals. So just a bit more of a background about St James's Place. It was founded in 1991, and we're a FTSE 100 company managing over 125 billion of client funds under management now. We've got a team across the UK of about 2,000 employees who can assist us with all our admin and any specific tax questions or pension questions, lots of experts. And we focus on providing a personalised, face-to-face holistic financial planning service. Just an additional layer of security as well, St James's Place guarantees the advice of its advisors, the suitability of that advice. So if we were to put a recommendation in place and it was found in 5 years' time that it wasn't suitable advice, St James's Place puts our clients back in the position they would have been in had that advice not been taken. So really, when you're looking to invest, whether it's your savings or a pension, we understand that it's taken our clients a lot of effort and time to build up the resources that they have. So our job is twofold. One, we want to make sure that we protect it. And two, we want to make sure that we can get it working as hard as possible for them so that it's there as and when they need it. In order to do this, when we're investing, we want to make sure we're asking effective questions, the right sort of questions. So you need to be thinking, how are you going to choose who's going to invest and manage your investments? How are they going to be monitored and by whom and how regularly? So at St James's Place, we've got a distinct investment management approach. This is three stages: select, monitor, and change. At the first stage of selection, we take a global approach to our investment management. So we don't just invest in UK shares. We look for the best in their field across the globe. We do this through our own investment committee that's supported by a panel of external experts and independent consultants whose job it is to keep tabs as such on the different investment managers that are out there and tell us who's doing well and what they're doing differently to others. Once we've appointed the fund managers, and the reason that we do it this way is, as in the way that we appoint them, is not to employ them in-house. We contract out the role of managing our funds. So this gives us a flexibility, because it means we can swap and change our fund managers as and when we need to, if they're not doing what our clients want, if we wanted to take it a different approach. But also it means that we're not restricted, we're not prohibited by cost. We couldn't possibly employ 82 fund managers from around the world that are the best in their field. So it gives us access to that service and we're not restricted. Once we've got them on the panel of our fund managers, then we've got an investment committee that's sole job is to manage the managers. So they will have hundreds of meetings a year with them. And yes, past performance is one factor, but it is not the most important. We want to know what they're looking to do and why they're looking to do that, the reasoning behind their steps moving forward, not what they've done well in the past. As part of this service, we go to great lengths to make sure that they are working in the interests of our clients. We even employ behavioural psychologists who will monitor the fund managers during these meetings to see how comfortable and confident they are in their investment decisions. And we're not afraid to change our fund managers. So we have to be bold. We have to make sure that what we're doing is right for our clients and it's the best possible option. So we are open to making changes as necessary. And another great thing about St James's Place as a manager of your pension or your investment is that those changes are seamless. They don't affect the portfolios you're invested in. We just swap the fund managers out. There's no tax implications to that. So where to start with your financial planning as barristers? Now, there's a whole host of different events that you'll experience throughout your life. You'll buy a home, you'll have a child, you'll potentially change jobs, you'll go traveling. Throughout each of these different life events, there are going to be different financial needs that need to be considered or taken into account. Now, our role at St James's Place and at Westgate is to be there with you from the start and make sure that whilst you're enjoying all of these different life's journey, that you've got someone behind the scenes to take care of the financial elements. So we're there every step of the way to make sure that you've got the relevant income protection at the start of your career, and at retirement we can sit down and discuss whether you should be pulling it out of an investment or whether it should be staying invested and you draw an income from that. How we do this is we provide a holistic financial service. So we can look at the protection elements, we can put a pension in place for you, we can run that pension throughout your working life and during retirement, we can do the long-term investments, and we can look at inheritance tax planning, long-term care. So we can cover all aspects of financial planning. Now, whether you're 18 or 80, there is a number of fundamental financial planning elements that you should try to get in place and sort of have as a tick box to see where you're at, what you need to do next. So firstly, short-term needs. You need to make sure that you've got your everyday spending, your money for your bills in a bank account. We can't do much with that to make it grow. We can't take investment risk with it. It's just got to be there. The same with the medium term. So we say this is 1 to 5 years of money. So this is your emergency fund, like Fee mentioned earlier. We like to say 3 to 6 months of expenditure, so you've got a nice buffer there. It's your planned spending, such as any holidays if you think you're going to need a new car. So that sits there. Now, as barristers, if you're self-employed, you're also going to want to be putting aside savings ready for your next tax return. That's where we would say that needs to go as well. And you might want that in a separate account, but it's in that medium-term box. So really, we're looking at things like a cash ISA or premium bonds. There's no investment risk. It's still easily accessible, but it's separate from your short-term everyday needs. Once we've got those 2 boxes ticked, we're really looking at the bottom 3. So protection is highly important. You want to make sure that as barristers, you're self-employed, you've got no employment sick pay in place. So we need to make sure that if you're ill for over the long term, that you've got cover in place so that your income doesn't drop, so that you can still afford to pay your bills, you can still afford to pay your mortgage, and it means you don't have to draw on your savings as much. Equally, once you've got a property, we want to make sure that you've got life cover, critical illness in place, so that you've got lump sums that can pay out and you don't have to think about moving house whilst you're undergoing whatever else is going on in your life at that time. Again, as mentioned before, property is a great investment opportunity, but also another key thing that we say to our clients you should try to get ticked. There is such a thing as good debt, and owning a home and having a mortgage is one of those. You're better to be paying off your own mortgage than you are your landlord's through renting. And whilst renting is a necessity, especially at the early stages of our working lives, the sooner you can get onto the property ladder, the better. And then, as Fee mentioned earlier as well, pension. It's free money. If you're saving into a pension, the tax relief you get on it is free money. So, for example, if you were to put £10,000 as a lump sum into a pension, £12,500 is going to go into that pension before any growth or anything. Equally, if you're a higher rate taxpayer, you're going to have an additional £2,500 that you can claim off of that year's tax return. So before you've made any growth, your £10,000 into your pension has achieved a further £5,000. And we've got state pensions, we've got state pension age. At the moment, for our generation, it's coming out at about your state pension age at 68. But we've got to question, how old is that going to be when we actually get there? Is it going to be more likely in the 70s? And we've got to say, is it even going to be there for starters? Are the government still going to be able to provide a state pension for us? And if they are, what level of pension is it going to be? Is it going to be in line with the standard of living that you've been used to while you're working? We really need to make sure that we're taking responsibility and saying, actually, I want to make sure that I've got that standard of living once I retire. I can go on holidays and I can enjoy my hobbies after working in a particularly stressful job. So we really want to make sure that we've got a pension in place. And once all of those boxes are ticked, then we're looking at long-term investments for the sort of 5+ years. It's money that you're hoping not to spend, but it's accessible. So we always say we want to have that long-term investment alongside a pension. You can access it as and when you need. So if you've got a wedding or you've got children's education, you can dip into it, which you can't do into a pension until currently age 55. So we want to make sure that's there. We want to make sure that the money that you have that's not in that short and medium term is really working hard for you, because if it sits in cash, there is still risk. There's the risk that it's going to be worth less because of inflation. So we want to make sure that it's doing something. So finally, just a bit about our charges. So as a financial advisor, like I mentioned before, we can look at all of this for you. There's no initial cost to have a chat with us. We can review where you're at and look at a plan. There's no cost for that. If you choose to work with us, we put together a recommendation and we run through a bespoke illustration which would outline the charges to you. Now, as Westgate's a service partner of the Bar Council, we do provide discounted charges to members of the bar, and all of this would be run through with you during the meetings so that you were made clear of what that is. But as with choosing where to invest and what to invest in, we've got to be making sure we're asking the right questions again. And cost is a factor, but it's not necessarily the most important, and it's certainly not the only factor to consider. We want to be looking at what the return is that you're achieving after charges. So just to give you an example, our balanced portfolio, which is deemed at the lower end of medium risk, between the period of 2008 to 2018, so that takes into account the market crash in 2008, it achieved 109% across that 10-year period after charges. So that's achieving 10% a year on average after charges. We also want to be looking at the level of risk. We want to make sure that you're achieving those returns, but that you're taking a level of risk you're comfortable with things like your pension. Depending on your age, are you able to take a more higher risk because you're younger? Once you get closer to retirement, do we de-risk that slightly? Again, that depends on what your plans are with the pension. If it's going to continue to be invested during your retirement, we might say, actually, we don't want to be de-risking it to a sort of lifestyle pension. It can stay in a reasonably high level of risk across our portfolios because you're going to be dipping into it, but you want it to continue working, continue building so that it's there for you for longer. And again, quality of the fund managers, who's managing your investment. We want to make sure that they're doing exactly what you want them to be doing. They're achieving good returns and that they're not going to be taking risks that you're not comfortable with. We want to make sure that the company that you choose to work with is financially secure. And we want to make sure that the service that you get, you've got face-to-face advice. You can phone up, you can email, and you've got a person, a contact that you can talk to who can make sure that they're there the whole way through your journey, rather than trying to sort of figure it out and make the decisions without any support. So I've just put there our contact details. You can see we're on the Bar Council's website. We've got our own website listed there, my email and contact numbers. I've gone through a lot. I could spend hours discussing the real finite details of each of these sort of different elements of financial planning. If you're going to take one thing away from this, then I would say just make sure that you take action, that you contact myself, contact a financial advisor that can help you to get a plan in place so that you don't just leave it, because the sooner you start, the easier it is to achieve your financial goals. Thank you.
Thank you so much for that, Louise. That was really helpful, as always. Louise has been fantastic in providing me with financial advice, and she's an amazing person. Last off, we have an amazing final speaker who has come in last minute. Thank you so much. His name is Alex Freed, and he is a chartered accountant and managing director of Philip Creed & Company. The firm specialises in acting for barristers and legal professionals and works with over 500 barristers, including myself. So Alex, please take it away.
Thanks, Natasha. It's really nice to be here and to speak to all of you. I'm not going to go into a tremendous amount of detail because this isn't a tax seminar. But I think it's obviously we all agree, and I think the other speakers have touched on tax in their own fields. It's going to be quite an important part of your financial lives. I've picked out 3 sort of quick wins, or really the things that I think are just so important. And actually, if I look at the clients that I do work with who are most in control of their finances, they're normally doing a combination of these things. So the first is to be early, and it sounds really obvious actually, and it almost sounds a bit too simple to be something that is a really important part of your tax strategy. you're all going to be you're not all going to be self-employed, but I would say most of you here are probably going to be self-employed barristers. Employed barristers will of course have their own tax affairs, but they're not going to be nearly as complex as the self-employed bunch. You're given quite a long time to file your annual tax return. So the tax return filing period starts on the 6th of April, and you've got until the 31st of January. It's really important that you don't treat it like a guideline rather than a deadline, and it's all about making sure that you do it in good time. It doesn't just make the process a lot easier and a lot less stressful. I think it also means that you can be a bit more deliberate, and you can sort of discuss things in a bit more in a civilized way, and ultimately it's just a lot more time that we can both spend to make sure that people are paying the right amount of tax. And when it comes to actually paying it, well, it's really important to know as early as possible what your final tax bill is going to be. We can all make estimates of our tax liabilities, and there's plenty that you can do to give yourself the best chance of estimating what your tax bills will be. But until you file the tax return, you don't really have that final figure in black and white. The second one is to get a bookkeeping system. And you can either sort of outsource the whole thing to someone like me, or you can do it yourself. I don't think there's any one way for everybody. And frankly, my opinion is that the best system is probably one where you do some of it and we do our parts. I think a system is really important, and just doing sort of bookkeeping as you go is the most important thing you can do to make sure you're paying the right amount of tax, because you're not going to be shy of different allowable expenses, and it's going to be much easier if you keep track of everything as you go, using a user-friendly system that doesn't sort of take a lot out of you, to sort of do the bookkeeping as you go. What I encourage my clients to use is an expense scanning app. It's called Dext, formerly known as Receipt Bank. All of the accountants that I know that work with barristers use that or very similar apps. And I think that the culture here is very much, as I'm spending money, I'm just capturing those expenses in my bookkeeping system. I could talk for a very long time about different systems. I think it's most important to pick something that you're going to really get on with, rather than something that me or a colleague does. There are many different ways to keep track of things, and you want to do the one that speaks to you. The third point, which I think is really extremely important, not just at the beginning, but throughout practice, and arguably it's more important as you sort of go on, I think, in life. I'm a big believer in separate bank accounts, and it sounds really trivial, but actually just compartmentalizing your sort of work income and your personal savings, your personal spending money, and then also your tax savings, I think is a really, really easy and efficient way to make sure that you're always sort of in control of where your money is. If you keep all of your money in one bank account and you're saving for tax and you're saving for your personal expenses and you're doing holiday budgets and you've got to pay chambers rent at the end of the month and etc., it's going to get really confusing. And actually, it's the number one way that people find that they have not got enough to pay their tax bill. So what I recommend to my clients, and what I think works really well when I've seen it in practice, is separate accounts for work and for personal, and every month put aside a percentage of your monthly receipts and put that into your tax account, and just try and forget about it. We're not really wired as humans to look at big numbers and it for not to be an emotional topic. So as much as possible, sort of try and treat the money that you are holding on to for tax or VAT as not yours, I found the best way of doing that is by using a separate account. I think I'm probably going to be more useful in a Q&A. So that's my 5 minutes, and hopefully that's been a sort of helpful 3 bullet points that you can take forward.
Thank you so much for that, Alex. That was really, really handy and helpful. And I know we've already got at least 1 or 2 questions for you in the Q&A. So now it's time for the Q&A. If all of our speakers could turn their cameras on so we can all see your fantastic, wonderful faces and not just mine, that would be fantastic. Right, so the first question that we have is, what is the #1 financial advice you would give to barristers at 5 years call, 10 years call, and then 20 years call? Louise, maybe you want to start off with that one, seeing as you're
absolutely nodding in the background. Okay, so I mean, it's going to be very personal to each client's circumstances. So if you've got a financial advisor to speak to, they should be reviewing it with you annually anyway, to make sure that you've always got the appropriate financial planning in place. But as a guideline, if you like, at 5 years call, your sort of early years of practice, you need to make sure, 1, you've got income protection in place, because if you can't work, you need to make sure that you've got some form of income coming in. 2, get a pension started. You don't have to be funding it heavily, but the sooner you start, the easier it is to get there. You've got the benefit of compounding, so you need to be getting it started. And once you've got that routine in place, then it's just going to become part of your monthly bills if you're saving monthly, or you put in as and when you can. Yeah, Natasha's yeah. So yeah, income protection, and then get a pension started at 5 years call. At 10 years, you should have that established, that they're both in the background, they're doing their thing. You want to be looking at your long-term investments, what you can do to make your savings work harder for you. So you should be in a position that you've got a property. Again, the mortgage is another bill that's just coming off monthly. So you want to make sure that your additional savings that you haven't got planned expenditure for can start to work for you. At this point, depending on, again, personal circumstances, how much you've got, we might start to look at more higher risk investments. So we've got venture capital trusts, enterprise investment schemes. These are great for tax relief. They provide 30% tax relief. There's different rules around how much you have to put into them and how long they have to be invested. And obviously it's back to that discussion around attitude to risk. At 20 years, cool, we want to be reviewing your retirement targets again, making sure that that pension is starting to look like an amount that you're going to be comfortably able to retire on. If we need to be feeding that more. And again, it's just going to be an overall review at that stage, making sure that everything you've got in place remains appropriate.
Thank you so much for that. Does anybody else have anything that they wanted to add to that? I didn't think so, because that was fantastic advice. Thank you so much. And just so you know, people, even though I like to pull faces whenever anyone talks about pensions, I do actually have a pension now. I am actually an adult now. Congratulations. My mum is very happy, because for the last 5-6 years, she's been screaming, Tasha, you need to go pension, alongside Tasha, you need to learn how to drive. But anyway, that's another story. The next question is, any recommendations on the best pension providers for self-employed barristers? Do you want to go again, Louise?
Yep, I'm back. Right, so Westgate, St James's Place, we manage your pension for you. We don't take high levels of risk. We've got different portfolios. We've got 42 funds, 82 fund managers across the globe. As I mentioned to you before, we've got our distinctive investment management approach. We'll review it for you, and it's face-to-face advice. So we're going to be there through the whole process, making sure that it's doing what it needs to be doing for you.
Thank you for that. And just so you know, I actually have a pension to them. So I would highly recommend. The next question is, what financial/advisory support is available that junior barristers should be aware of if they're starting to struggle financially? And I will probably start off with that in terms of the bar stuff that's available. As far as I'm aware, the Bar Benevolent Fund is still giving out money to support barristers, and the Inns are also providing support as well. But perhaps maybe, Alex, if you're there, if there's anything else that the government is providing at the moment in respect of coronavirus support, that would be helpful.
Yeah, well, I mean, the sad answer is that probably not enough is my view. You will already know, I'm sure, people who are participating, who are watching this, you will know whether you qualified for the self-employed income support scheme that was run last year. There were 3 grants that have already been delivered. The 4th grant is being delivered at the end of the month, and we're going to get a 5th grant. Now, I think, you know, that's going to be the end of the self-employment income support scheme if our sort of roadmap does continue on plan. They're making it a bit more difficult to qualify. The 4th grant and the 5th grant are coming with a few more restrictions in terms of who actually can get the money. Outside of self-employment income support scheme, there's not much that the government is offering, particularly with COVID, unfortunately.
They hate us. Thanks for that. Right, so the next question is, can I move a SIP pension into a managed pension? But I think the first question for most people in the chat would be, what is a SIP? Before you answer the actual question. So Louise, if you could help us out with that one.
Yep, so a SIP is the abbreviation for a self-invested personal pension. So what it essentially means is that you're making the investment decisions behind the scenes. They're often slightly more expensive to run, and the main reason for them is that you can hold commercial property in them. And by that, it's not shares in a B&Q outlet, it's you've got a physical commercial, an office premises in as part of your portfolio. So they're quite a specialist pension, if you like. We would recommend them if they were suitable, but for most barristers, we're saying unless you're going to be buying into chambers premises, it's really not a pension that you need, especially with the higher charges. So yes, they can be moved. We can do that. We do all the due diligence behind the scenes, make sure it's the right thing for you to be doing before it's moved, and explain everything in the paperwork. But yeah, SIPs, they're an old-fashioned concept, if you like, that were really popular, but nowadays, unless you really want to be holding commercial property in your pension, then I wouldn't advise it. And if you're interested in property, you can invest in property shares, if you like, so you can have that as part of your portfolio, but you're not directly you don't directly have a premises in that pension fund.
Thank you for that. Can you move it into a managed pension?
Yes, absolutely. So ours is managed. We manage our investments, our pensions, so we can look to move a SIP into our pensions. Perfect.
Thank you so much. The next question is, what tips would you give junior tenants at the start of their careers in terms of planning for the future and mortgages? Now, I think you've probably given us some advice on that so far. But if there's anything else, bar pensions and things, anything that you could give us, any tips about saving for a mortgage would be particularly helpful. Does anybody on the panel want to take that one?
Sorry. Definitely things to bear in mind are mainly, the main one I see a big problem with is actually people that don't keep on top of their credit score. Certain things can pop up on your credit score that you didn't realize. One of the big ones that I see actually is people doing a lot of searches on Go Compare for car insurance. That is a search against your name and it can drop your score. So if you do repeated searches after search after search to get that car insurance quote, it can dent your score by quite a lot. And so sometimes you have things on your file that you didn't even know were there. Vodafone are notoriously bad for putting accidental defaults in people's names, and they don't realise until they ask us for an agreement in principle, it declines, they download Experian or Equifax, whatever it is, and they see that problem on there. So it's definitely a really good idea to keep on top of things like that. And also just, chuck as much into savings as you can, really, because the lower that your loan to value is, the better rate you're going to get. Because right now, 95% mortgages have just come back into the market, and the rates are incredibly expensive, starting at about very, very high 3s and very low 4s kind of is the level that they're sitting at. Whereas if you were at 75%, you're getting a rate that starts with a 1. So the difference is massive, really.
Well, now that I have you, you kind of touched upon some things that I was going to ask you about. And the first one was going to be, how important is your credit score when it comes to trying to get a mortgage?
It's massively important because, for example, at 95%, you need to meet the lender's highest score within their internal matrix. And that's not just what it shows on Experian, what it shows on Equifax. A lot of different criteria feed into it, as in, is your income above a certain level? What loan to value are you applying for? And then just data they have on you. Are you registered on the electoral roll? Do you have a home phone number? All of those things that you wouldn't really necessarily think about too much can make a massive difference. Also, if you live in a flat, the format of your address on Royal Mail versus the way that you've set it up with Barclays or Santander can make a difference, because they can't find you. And if they can't find you, then it's not going to match up and your score isn't going to be as high as it should. So if you call Experian or if you call Equifax, you can get all of that amended to make sure that it all matches up.
And for those who don't know, what is loan to value?
So loan to value is either the amount that you put in versus the amount the lender's going to lend you. So for example, if you're buying a property at £100,000 and you have £25,000 to put in, you're at 75% loan to value, as you need to lend 75%, the difference basically. So if you have a deposit of 25%, you have £25,000 if you were buying £100,000.
Thanks. And before I go back to the questions that are in the Q&A, what other expenses other than your deposit do you think about when you are trying to buy a property? I asked this question because when I was going through it, it felt like people were asking me for money every other day. If it wasn't the mortgage company when they were asking me to pay for the valuation, it was my accountant to write a letter, or it was this, that, and the fifth, solicitor, everybody. It was too much. So if you can help us, that'd be great.
No worries. The massive and the main killer, as people like to call it, is going to be your stamp duty. The holiday obviously is till the 30th of June and people are going like mad to try and get things through before that date. So there's a stamp duty holiday until that date. It extends a little bit for certain purchase prices underneath 250,000 until October, but then it just goes back to the normal rates. The other things that people don't really think about is there's a base solicitor fee that you'll be charged, but then there's also disbursements on top of that. There's a lot of fees in relation to leaseholders when they have to go to management companies and request a lot of different information, and everyone charges for everything, really, basically. So you have a lot of fees within that you have to pay. Different lenders will either charge you a valuation fee or give you a free valuation. And that's something that we weigh up for you, whether it's worth paying the valuation fee for the better rate or whether it's better off going to the lender that doesn't have a valuation fee, as it may be a difficult property or something like that, or the fee just may be too expensive and we don't want you to pay something so expensive for something that may not work out for whatever reason. So those are kind of the main costs to be aware of, but the stamp duty one is definitely the main one that hurts a lot.
Thank you so much for that. And I'm really sorry to be taking, I'm just thinking about all the questions I had at the time. Another one that I've got at the moment, which, yes. Okay, so fixed terms.
So for the majority, you go for a 2 or 5 year fixed rate. In other countries, they give you like a fixed rate for the full term, but unfortunately, we don't really get those here. The maximum you can get is a 15 year fixed rate, really, and those are incredibly expensive, starting at like late threes really to get one of those. And they really kind of don't work out, because if for any reason you needed to repay it, the early repayment charges are so high that it really doesn't overly work out. But your fixed rates tend to be 2, 3, 5, 7, 10 and a 15 if available. But 10-year fixed rates are actually relatively good right now for a certain level. If you're lending at around 75% loan to value or less, you can fix in for 10 years at 1.99%, which, considering if you go back about 10 years, rates were about 15%. That's pretty good.
That's cool. And just so everybody knows what we're talking about when we're talking about rates, we're talking about interest.
The interest rate you pay.
Thank you.
On the loan.
Right. So thank you so much for that. Going back to the questions that were listed before, how do barristers make payments to student finance? Alex?
Yeah, so a self-employed barrister will pay their student loan repayments to HMRC alongside their other self-assessment tax payments. So you will be paying income tax, class 2 national insurance, class 4 national insurance, and student loan. It will just be one figure that you pay to HMRC. Almost always it's going to be 31st of January, 31st of July. When you start repaying the student loan depends on your income. So, and it depends on what type of loan that you have. There are basically 2 different types of student loan. Plan 1 for people that started before 2012, and Plan 2 if you started afterwards. Plan 2, you start to pay at a higher threshold. And there's also, if you've got a postgraduate loan, it's got its own repayment threshold, but it gets done through the tax return and just gets bunged along with the other tax payments.
And Alex, if one barrister, say, had just cash, just lying around, just cash, just there, would you recommend that they pay off their student loan?
Without giving it like investment advice, I think as a logical proposition, if you are incurring a rate of interest on the student loan that is lower than, that is higher than what you're making in terms of the return on your savings, then it would make sense to discharge the loan that you're paying at a higher rate of interest versus versus your savings or an investment. But I don't think that's the end of the story, because I'm fairly certain that Courtney might say a bank won't mind your student loan debt like they would a different type of debt, and in some circumstances it might help you to get a mortgage if you don't discharge the student loan. I think unless you have like significant excess capital, it is quite rare that people early repay their student loan. But I think one of the other speakers probably can provide a bit more context there.
Does anybody else have anything to add? Courtney?
Yeah, no, actually, when you have a student loan in place, for self-employed barristers, they actually ignore it as a commitment. So it's not something that reduces your affordability at all, because it comes straight off your tax return. They don't have the ability to discount it in the same way that they would for an employee who it's clearly on their payslip and there's the deduction. Because it comes out of the return, it doesn't actually get counted in. So
At least we win somehow on something. Anything else? Anybody else have anything to add? No. Okay, so the next question, and someone's put one in the chat as well about ethical pensions and ethical investments. So perhaps maybe in terms of ethical investments, Carl, do you have anything to say about that?
I guess the direct question is best way to go about identifying them. There's not an easy way. There are platforms out there. I can't name check any from memory that do highlight ethical investment products. ESG more broadly is becoming a huge thing in the investing world, and so individual companies as well as funds put more and more ESG data into their key information documents and onto their investor relations website. So that's one great starting place of finding out about them. What I would say about ethical or funds that are branded ethical is to make sure you understand how they're measuring that and how they are interpreting that. One example is exclusion. It might be that a company is saying, a fund is saying, if a company does X, Y, or Z, we deem that to be unethical and therefore we won't invest. And that's all well and good. You just need to make sure you understand what's happening. On the flip side, you could make the argument if you're a big enough investor, if you're say a BlackRock, that I want to invest in companies that are doing X, Y, and Z, which we might deem unethical. Because I'm such a big fish, I can push them to change, to improve those things, and to do better. So I think, yeah, the advice there is just make sure you understand how they're approaching being ethical, and that it aligns with how you want your money to be used effectively.
And Louise, do you have anything to say about ethical pensions and investments?
Yeah, so I suppose to sort of say what's the best investment, what to invest in, and how to choose a fund, it's a very difficult question. It's like, how long's a piece of string? We've got thousands of individual stocks in this country alone, and we wouldn't advise to just invest in the UK because you could be missing out on opportunities in North America, in Japan. So you want to make sure that you're diversifying your investment globally and also across the different sectors. Having said that, there are ways to make sure that your investment can be sustainable and ethical. So, for example, at St James's Place, we've got a sustainable and responsible equity fund. So that's driven by these sorts of factors. Just as an example of what it's achieving, it's avoided the equivalent of 10,760 cars on the road in 2019 alone through its investments. Also, all of our fund managers are signatories of the United Nations Principles of Responsible Investment. And what that's really driving is that investment decisions are made taking into account these ethical, social, governance factors to just make sure that the investments have got that accounted for. So there's things to look out for like that. We also have teams at head office who can look at all of our funds and they can say, right, if you've got a preference, I don't want to invest in oil, we can make sure that we can put a bespoke portfolio together that takes out any funds that would invest in oil. So like you said, the exclusion, Carl. We've also got other teams that can put together complete bespoke portfolios. So if you said, I want to focus on tech, I think, post-COVID, Zoom has become something that we didn't even realize we needed, and tech's going to fly. So I want a tech portfolio. So we can look to put together sort of specialist portfolios if that's what you're looking for, in the same way as we can put together ethical and sustainable portfolios.
Thank you so much for that. Is there an ideal split between savings and investment? Louise?
Yeah. Okay, so again, quite a difficult question. It's going to depend on your individual circumstances. So if we had a client that, for example, had several £1 million, we would be saying to them, you don't need to have 20% of that in cash, in savings versus investment. We can afford to invest more because you're just not going to spend that. And it's back to that, the circles that I showed you, the different boxes and ticking them. As a starting point, we need to make sure the short and the medium term boxes are ticked. Once they're ticked, we can start to look at investments. If we're going to sort of ballpark it, I would say 75 to 80% of your wealth can afford to be invested once you've got those boxes ticked.
Thank you for that. Now, Carl, question for you. Are crypto accounts a way of achieving a higher return on savings?
So that question, I was looking forward to it. Yes, I'll give you a short answer and then I'll give you the longer answer. The short answer is yes, theoretically, with a lot of risk. So, and here's the longer answer. If you think about a boring old savings account that earns you nothing, the one thing you do have is certainty. Your cash goes in, and yes, inflation does its thing and erodes its value over time, but 100 in is 100 out, and you roughly know, as far as the eye can see, what you can buy with that. Now, if you put that money into a cryptocurrency, like just look at the weekend, like with certain cryptocurrencies, that 100 could become 1,000 overnight, and that's great. At the same time, that 100 could become 50 overnight, and so, and that's the risk you're taking. And so, I think, like, my view is it's something you do with play money, right? So if you've got a 30 grand portfolio, are you going to miss £200 in crypto? No. If that £200 goes to zero, okay, well, at least you had a go. If that £200 turns into the next Dogecoin and becomes £5,000 before you wake up the next day, fantastic. But it's difficult to include a large amount of crypto in a balanced and sustainable investment portfolio, which isn't to say don't have some fun with it and don't give it a go.
Thank you so much for that. I just sat there like, yeah, thinking how risk averse I actually am. Just so you know, guys, there's 4 minutes until 7, but I do want to get to all these questions because some of them are really, really good. So you might run over a smidge. I hope you guys don't mind. The next one is a mortgage question. What advice do you have for junior barristers who accounting year ends almost a year before their tax returns are due? Is there any specific evidence other than tax returns that lenders prefer to persuade them of your current earnings / earning potential?
Yeah, so we actually have a lot of clients whose accounts are for the 30th of April rather than the 5th. Alex is nodding, I can see. So a lot of, it's just more, as far as I'm aware, it's more of an efficient tax way to do things. But the way that we do that is we just provide the accounts. Not all lenders will accept accounts, but some of them will. And that's the way we like to try and get the best out of the borrowing that we can. So for example, if the tax documents show the best and the highest level of income that we need to get to the amount, then perfect, we'll go with that. But if we need the accounts that show a higher figure, then we're gonna go with those. Other documents that we use to back that up are, I get a copy, this is a standard thing I ask everyone for, I get a copy of the age debt report from the last accounts to now, payment summary from last accounts to now, and work done report from last accounts to now. Just so then that helps me to paint the entire picture, really. I use all of that information to say, okay, I've looked at this, their chambers costs are X%, realistically, their next set of accounts are going to show around this figure. And then I also get a projection from chambers to kind of back it up. But that's how we kind of present that. But in most cases, we can try to use the accounts, which helps.
Thank you so much for that. My face is like this because it's just bringing up like the trauma that I went through. It was absolute trauma. It was like the bank was just my husband. I call him my husband, the bank. He was just like, "Why did you earn more?" Like, thanks. And then also like, "Can you just do a projection?" Like, okay. So I was just asking so many questions. But anyway, enough about my trauma. The next question is for Louise. When would you suggest is the best time to speak to an investment manager? This particular person's always been under the impression that it's only worth it if you're earning a large amount, for example, 150k a year plus.
Okay, so talk to somebody straight away, because it doesn't matter how much you've got, where you're at in your career, your life stage. We can make sure that you're putting the right planning in place. So just our average client at St James's Place, they've got invested 40,000 across their pensions, investments, everything. So you can see that you don't have to be a high net worth earner, if you like, before you can access financial advice. As a guide to what our minimum investment amounts are, if you want to save into an ISA, so just your sort of tax efficient investment, if you want to save regularly, so monthly, it's £150 a month. It's not inaccessible to people who aren't earning 150,000. Equally, into a pension, it's £200 a month regular that you need to be to start saving into a pension with us. So the advice is available to everyone. And I would say the worst thing you can do is to not talk to somebody. You need to try and get some planning in place. So don't hesitate to contact us. And yeah, it's a myth, is what I would say to that.
Thank you so much for that. Now, the next question that I'm going to ask is buy-to-let properties or pension fund for retirement. What would people recommend? Does anyone want to take this one?
Yeah, I'm happy to. Okay, so there's lots of different factors to consider between buy-to-let and a pension. So with a buy-to-let, you've got to think about the liquidity of the property itself. So although you'll have a steady rental income, provided you've got a tenant, if you needed to access a larger amount, how are you going to do that? You can't partially sell a property. Whereas with a pension fund, you could say, I need to draw out X amount because I've got to buy a new car this year, or I want to go on a around the world holiday and it's going to cost me a bit more than my standard living. So you haven't got the flexibility with a buy-to-let. People like property because it's something tangible and it's there. And if you have got a continual tenant, you've got a good income stream coming in. But again, if you're investing with the company that's managing it for you, it should be achieving good investment returns. You should be able to have conversations with them about drawing down on that. So again, just to use the figure, if you've got a pension that's worth £300, that's going to give you 12,000 a year, so £1,000 a month income from your pension of 300,000. Now, if you're achieving good returns, so like I mentioned earlier, our balanced lower medium is achieving on average 10% after a year, that should be replacing what you're drawing out as well as some. So you should be pensioned for life at 4%, and it should still be there for you, for your beneficiaries at the end. And so I would say a pension is a great thing. There's the tax implications too. So with a buy-to-let property, if you do choose to sell it, there's a higher capital gains tax on it than there's no capital gains on your first residential property. So if you're a higher rate taxpayer, you're going to be looking at paying 28% capital gains tax. So there's all those different sort of factors to take into account. There's also diversification. You're invested 100% in property, and you're invested 100% in that one property rather than globally across different shares. You've got some cash in there, you've got some bonds in there. So there's lots of things to consider when you're looking at buy-to-let, but I would recommend a pension versus a buy-to-let, definitely. I wouldn't choose buy-to-let myself.
Courtney, you want to? Sorry, Alex. Jump in. Hi.
Sorry. Can I just add? I think you're really correct to flag up the difference in tax treatment. So if you are going to do I don't think that the investment case for either of them is not really my domain, but if you are going to do a buy-to-let property, you need to understand not only, as Louise said, the capital gains tax position, which can be quite substantial, but also the income tax position, because what you're effectively doing is you're running a rental business. You can be taxed like a business, and actually you're going to be taxed in about the most unfriendly way that it's possible to be taxed if you've got a mortgage, whereas pensions are extremely tax efficient. So it's definitely something that I would really research the immediate and long-term tax consequences before doing.
Sorry, can I just add a final point to that as well? So on the tax side of things, you've got inheritance tax to think about. If you're looking at it as a retirement, your retirement, then you need to be thinking on death, what's going to happen to that? So if it's a property, it's part of your estate, it's going to be taxed 40%. You've got certain allowances, but they're going to be used up on your main residence. And unless your estate's smaller, then it would be covered. But if it's bigger than those allowances, it's going to be 40% tax on that property for your beneficiaries. They've got to find that tax. With a pension, currently they're outside your estate. There's no inheritance tax on them. So if you're building up an extremely large pension, you're building up savings alongside, we might be suggesting at retirement age, right, let's live on the invested savings to start with, because if we can not touch that pension, that leaves a much larger inheritance for your beneficiaries that's tax-free. Whereas the savings, the property, they're all within your estate. So we might be looking at, right, let's downsize, let's use the savings, let's use anything that's taxable before we even touch the pension, because we want to be looking at what's both a good investment choice for you, a good financial planning decision for you, but also looking for your beneficiaries, your family, those that are going to be affected by it as well, and making sure that it is the right decision for everybody.
Thanks, Louise. Courtney.
The only other thing I would say really when it comes to buy-to-let, and we're seeing a lot more of it now, is a lot of people buying in an SPV, so a special purpose vehicle, which is basically buying the property within a limited company name, which helps with the tax a lot, because you get penalised so much if you have it in your personal name, because when you operate as a limited company, it's your tax as if it's a separate business, so that it's taxed on the business purpose rather than in your personal name. That's the way that it's working now, and it's a lot on an affordability model with lenders. If you're buying it in a limited company name, the stress and the affordability model they offer you is actually a lot better. If you were buying the same property in your personal name versus a limited company name, you'd be able to borrow more as a limited company than you would in your personal name. So that's the way that we've seen a lot of people who really want to invest in property get around this massive tax issue, that they've basically made it not worth it to have a buy-to-let in your personal name, really. So we've got a lot of people buying in a limited company name.
Thank you so much for that. The reason why I pulled the face was because I was like, I did not know, and typed that down. So just for those who are saying, forget them kids, like myself, can we talk a little bit about like buy-to-let, and in particular buy-to-let mortgages, and what the difference is between those and residential mortgages, you know, the interest only or repayment, all those sorts of stuff to consider. Courtney, one, I've got you.
Yeah, well, so the majority of mortgages in relation to buy-to-let are going to be on an interest-only basis, because that way, when you get that rent in, you're actually able to, well, attempt to make a profit on it as far as the income you get in. Obviously, then it does get taxed by quite a bit. So if for example, if you were to buy it in a limited company, you have to set up a separate limited company for one of 3 or 4 purposes. There's a certain I think there's 3 or 4 they're called SIC codes on Companies House, and it has to be set up for one of those exact reasons, basically for running and or operating property. Otherwise, it doesn't qualify for a limited company buy-to-let mortgage. It's assessed differently because in most cases, it's just assessed on the rental, and there's a stress test that's worked out on that. A lot of cases, the rental itself has to meet the mortgage payment at 145%, stressed at 5.5%. It's very overly complicated, but they basically stress it so much so that they take into account all of this now tax you've got to pay. And once you take all of that out, can you still afford the mortgage? That's the generalization of it, but that doesn't take into account anyone's personal income or anything of that variety. But because of what happened with the crash and all of those things, the regulation came in so that they had to have all of these really, really stringent tests to make sure people can afford it, and they didn't have more situations where they borrowed so much money and couldn't afford it. And that was the case really with a lot of buy-to-lets.
Thank you so much for that, Courtney. And Alex, asking for a friend, if one were to say purchase a property that they wanted to rent out, what kind of tax, I know you've touched on it before, implications do we need to be thinking of if we were doing it in our own name rather than using a special purpose vehicle, which I will Google after this event?
Well, I suppose there are two or arguably 3 things for tax purposes. So the first is, if you already own property as your main residence and you buy a second home, you're going to pay a surcharge for stamp duty at 3%. So that's number 1. Number 2, already mentioned, capital gains tax when you sell the property on the gain. You've got the highest rate, which is 28%. So normally a capital gain would be at 20%, but here the highest rate for residential property is 28%. But the income tax position, so if you have a property in your own name, you need to report the income and expenditure associated with that property. All allowable expenses, so basically, you know, everything that goes towards you being able to generate the rent, so, you know, maintenance, agents' fees, insurance, service charges, whatever, they're all allowable in full. So they're just treated as a deduction from your profits for tax purposes. But it's the mortgage interest. And if you've got a buy-to-let property, you're probably going to be doing it using an interest-only mortgage. You'll only get 20% relief for the mortgage interest. And if you're higher than a basic rate taxpayer, i.e. total taxable income above 50,000, you're paying tax at 40% at your top rate. You're effectively paying a much higher rate than 40% on the rental profits. And in some circumstances, I mean, if you had like 5 or 6 rental properties like this, you know, you would really be paying quite a lot of your real world profit in tax. There can be even some circumstances where there, you know, professional buy-to-let landlords who had 25 properties or so were facing more than 100% tax rates if they didn't do things like putting them into these companies. So I would say, when I'm asked about this, I would say buy-to-let properties are about the least tax efficient thing you can do, versus a pension, which I think is probably the most tax efficient thing you can do. So that doesn't mean don't do it, because there might be really good reasons to own property, and actually but just from a tax perspective, I think it's really not a very friendly environment.
Thank you so much for that. I like to pull faces whenever pension's mentioned, because it's just the word pension, it's just so unsexy. But anyway, we move on. Right, so a question was listed, which is, what are the best tips for barristers to get on top of their tax responsibilities? Now, I think, Alex, you've already covered it before when you were talking about putting a percentage away into another account and not touching it until whatever. And I know you've also said that you can't tell us the percentage, but how would you recommend we go about calculating it?
It's not that I won't tell you. It's
Is it that you would tell me for myself,
but
not everybody?
We have a marginal tax system. So what that means is that the higher your profits are, the higher the overall percentage of tax that you pay. So, you know, if your profits are 25,000, you pay less than if they're 50,000. And as we start to add taxable profits, the overall percentage of tax that you pay gets higher and higher. So without knowing the context of someone's accounts, it's not just not possible, but it's actually quite unhelpful for me to say, put X percentage away, because it would need to be flexed up and down for each individual circumstances. And I think the best thing to do, I think this was already mentioned in the Q&A, I think just ask an accountant, whoever's doing your tax returns. It will not be a very difficult exercise for some. I do this on a very regular basis to give people a sort of, you know, weatherproof percentage that they should put aside for their tax payments. I already answered one of the questions. I sort of got a bit overconfident, and I answered one of the questions before, which was saying the same thing. I didn't say put 8% aside in my talk. I just want to make that clear in case I was being unclear. I think if you're just starting out and you're sort of not sure about how much to put aside, you probably can't go wrong by over saving and then getting everything done really early. And, like, you know, as soon as April hits after that first year, you know whether you've got too much or too soon, and you can sort of adjust as you go along.
Thank you so much for that. And a segue, if I may. I have another question, but it's not in the Q&A. A lot of barristers have money for tax, VAT, payments set aside in the separate bank accounts. They have followed what Alex has said to a T, perhaps even more so. And yet they want to know, what can they do with that money to make it work for us so that we can get some money off of that money before we have to pay it to HMRC, our best friend. Does anyone have any advice on that? Louise, do you want to go for it?
Yeah, okay, so it's really difficult because savings accounts rates are dreadful and we can't take investment risk with it. We can't say, right, I've got 20,000 put aside for my tax bill in January, I'm going to invest it, and then something happens like last year where the FTSE as an indicator dropped 113% or something along those lines straight within a couple of weeks. We can't take that risk because then you'll be thinking, I had 20,000 for my tax, I've now got 5,000 or 10,000 and I'm not going to be able to meet it. So because it's short term, we can't invest tax savings, if you like. What we can suggest is premium bonds. So these are, Natasha loves premium bonds. So these are government backed and essentially it's a lottery monthly. So you can put up from as little as £25 in there, and the prizes that range between £25 and £1 million. They're tax free. We've yet to have a client win the £1 million, but we hope they will do soon. And so any of that prize money, it can go into your bank account, and it's probably the best return you're going to get without taking any risk at the moment. It's really frustrating because you've got that money sat there and it could be doing something, but it's just not good advice to be investing that. And premium bonds are doing better than savings accounts. So that would be my number one advice, put them in premium bonds.
So for about 10 months, every 2 months, I kept getting a text saying that I'd won on the premium bonds. And I'd normally on my balcony drinking a coffee in the morning and I was like, what, I won? And the first time I won, I was just like, oh my God, how much do you think you won? And I was like, well, if it was £1,000, I guess that would be nice. But really, I want £500,000 at least. Oh my God, I'm so excited. Went on my computer, it was £25. And every time I won £25, apart from the last time, which was £50. And I haven't won for a while. But yes, premium bonds. Courtney.
I was just going to say another good thing to do is chuck the money. If you have a mortgage and we go for an offset mortgage, brilliant thing to do is to chuck the money into your offset account. And what happens with an offset account is if you have an interest rate of 1.62% on a capital and repayment mortgage, and let's say you have £100,000 mortgage and you have £100,000 of savings, if you chuck that all into that account, then you're not going to be paying any interest on the loan at all. You're only paying back the capital for the entire time that money is in the account. So it can be really beneficial for barristers throughout the year to just chuck all that money into the offset account, because that way, yeah, they're not necessarily making money on it, but they are saving money on it, because that way they're not paying any interest on the loan. And even if you have £100,000 mortgage, 20,000 of savings, well, for that 20,000 that you have in the offset account, you're not going to be paying interest on that £20,000. So you would only be paying interest on the 80. That's the difference. So it can be really beneficial to just chuck that money in there. If you would just have it in a Barclays account anyway, why not chuck it into the offset account?
I did not know that existed. So thank you so much for that. That's another thing for me to Google after this event. Now, is bullion worth investing in, Carl?
I mean, I'm happy to give an opinion. Anything can be worth investing in at the right price or in the right circumstances for a given person. But in my opinion, no. Here's why. A good investment yields something, right? If you own a share, you have a right to that company's cash flow, and that's usually reflected in the forms of dividends down the line. With a bond, you have a regular income, a coupon payment. Yes, there are commodities where you're effectively speculating on the future price, and that's what you're doing with gold. In the short run, there are great opportunities to buy gold if people are nervous in markets. Like like Louise, like you mentioned, when the FTSE crashed 13%, look what gold did, it shot up. People buy gold in times of safety. But when you own gold, you're getting nothing for it. Your only bet is that you can sell it for more than you bought it down the line. And that's not in your control. That's not in anyone's control. That's a supply and demand mechanism. And it's a really old sort of way of thinking. So if we go back a few hundred years, like if we're in the middle of a war, you don't have to go back a few hundred years for that, but still, if we're in the middle of a war, you'd buy gold, you'd keep it under your bed, because if you had to leave your house in the middle of the night with all your earthly belongings, you could trade that gold for a piece of food, or to get into the safe town or whatever it is. Gold had, real world value outside of any financial system. Now, you just tap your Amex or whatever if you're running away. So it doesn't have that use anymore. If you want to put it under your bed just in case, fine. But it's, all else equal, it's usually as a long-term, thinking long-term, 5, 10, 15 years, it's a dumb use of money. If you're going to put money into commodities in general alongside everything else, then yes, you have a bit of gold in there alongside a bit of other precious metals alongside energy commodities and so on. But just betting on gold, in my view, isn't worth doing.
Thank you so much for that. And the final question is, what is the best advice on debt for young barristers, other than pay it? Does anyone have any advice that they could give?
Load up, interest rates are 0. I'm going to get slapped down by everyone else now, aren't I?
Anyone want to beat him? Anyone? Who's first?
I would say you need to be prioritizing what debt you're paying off. So like I mentioned earlier, there is such a thing as good debt. So if the interest rate is really low and you can be performing better investments, so if you've got a mortgage, you may not choose to pay that mortgage off entirely. You might say, I'll keep doing the monthly repayments, the interest's really low, I'm going to invest my long-term capital, it's going to grow more than what I would be gaining by paying the mortgage off. With things like student debt, the interest rates can be really high. So I would say you need to prioritize paying off the debts that have really high interest rates, the ones that are going to affect your ability to get a mortgage and things like that. So it's about looking at the different types of debt you've got and deciding whether it's good debt or bad debt, if you like, and then prioritizing it. I mean, in an ideal world, you want to be in a position where you have no debt and everything, you've got savings, you've got all those other boxes ticked, and you've got your property and there's no debt. But if we're talking, we've got a mortgage, we've got student loan, then it's prioritizing it and deciding whether it's a good debt to be having, whether you should be investing alongside it, or whether you should be really focusing on putting your savings into paying that debt off.
Anybody else have any advice or tips? I'm completely useless. I'm not a financial advisor. I just said pay it. So thank you so much, panel, for sticking with us, for answering our fantastic questions, and for sticking on for longer than we had planned. You guys were all absolutely brilliant, as I expected. And I have learned so much from this event. Thank you so much to Garden Court for allowing us to use their Zoom. And thank you everybody to attending. Thank you so much. I hope you've learned as much as I have, if not more, and you find some use in this event. As I've said, it's going to be put on the BBN website. And please don't forget the 34% off that you lovely attendees can get off of the Finimize app. So thank you very much, everybody. Have a good evening, and hopefully see you again at the next BBN event.